Right, I'll call to order the October 25th meeting of the Santa Barbara City Finance Committee. And the first item on the agenda is the quarterly investment report. We don't have anybody in the audience for public comment, so we'll go right to the staff presentation. Ms. Nemes.
Good afternoon, Chair Hart, committee members. I am Julie Nemes, Treasury Manager for the Finance Department. Today, I will be presenting the quarterly investment report for the quarter ended September 30th, 2016. I will be going over 5 different areas today. First being a little information on the interest rate environment. After that, some information on the investment strategy and approach. Then we will be going over some long-term trends regarding interest earnings and the interest rates. After that, a comparison of the city's results to benchmarks. And finally, the quarter investment performance and activity. First, a little information on the interest rate environment. As I've mentioned over the last few quarters, the Federal Reserve did increase interest rates for the first time in 7 years in December 2015. At the time, they hinted at additional rate increases in 2016, but we have seen no increases to date. However, they do continue to hint at additional rate increases by calendar year end. There are 2 meetings that remain in 2016. The next one is November 1st and 2nd, which is right before the election, so it's pretty unlikely that it will occur at that meeting. That leaves December 13th and 14th, the last meeting of the year. There are several or many economists that do believe a rate increase will occur at that meeting, but we will wait and see what happens. There are many economic factors that may have impacted why no interest rate increases have happened to date and whether or not one will occur at that meeting in December. There continues to be a lot of global uncertainty. Britain leaving the European Union is a factor. European and Asian banks charging negative interest rates. Economic uncertainty in China, which is the second largest economy in the world. There are a lot of global stock markets that have plummeted over the last year. All of these factors have had some impact on domestic growth. We're unsure how much of an impact. A lot of it relates to exports, consumers' confidence, and that impacts how much they spend. In addition, there has been moderate job and wage growth. The last 2 jobs reports have been average. They haven't been great, but they haven't been terrible. The Federal Reserve's target inflation rate is 2%, and it's still not quite there yet. It's about 1.6, 1.7%. And another economic factor is the presidential campaign. The Federal Reserve does state that this is not a factor for them. However, many economists do believe this plays into their decision. Another factor that many economists have recently spoke out about, and even some banks have come out and said that higher rates will allow the Federal Reserve to then cut rates in the future. This will then allow them to stimulate the economy without going into a negative interest rate environment. So this may come into play into whether or not they do raise interest rates in December. So over the last several years, we've seen Treasury rates continue at very low levels. The 5-year still hovers around that 1% mark. Interest rates are slightly higher at September 30th compared to June 30th. However, as I mentioned, they are very low. The 2-year did show the largest increase, and on the next slide, I'll be going over a chart that shows all of those rates. I did want to point out that if the Federal Reserve decides to raise rates at December, or whether rates just increase on their own by the end of the year or throughout 2017, it will take several years before we see a material impact on interest earnings for the city. We have to wait until investments mature or are called before we can buy back into the market and we see a real impact. This chart presents interest rates from 6/30 all the way through 9/30. As I mentioned, all of the rates have increased since 6/30. From the 1-year to the 5-year, that's where we see the biggest gains. The rates are 1.59 through 1.14 for the 1 to 5-year, and those really are the terms that the city primarily invests in. I did also want to point out that LAIF over the last several quarters has been increasing, and LAIF has about half of their portfolio is in treasuries, and their average maturity days to maturity is about 165 days. And we have noticed over the last several quarters that the shorter term maturities have been performing better than the longer term. So we think that that's playing into why LAIF has been performing better than, or more consistently than many of the other treasuries. A little reminder on what our investment strategy and approach is. Our primary objective, safety first, protect principal, then liquidity, meet the cash needs of the city, and lastly, yield, try to earn a fair rate of return. We buy into the market, we don't chase yields. We attempt to maintain a steady maturity over a 5-year period. That really is to ensure we have adequate liquidity to meet the cash needs of the city, and also prevents us from investing too heavily in a bad interest rate environment. This chart is a comparison of the city's portfolio rate, which is in blue, to the 5-year treasury, which is in purple, to the 2-year treasury, which is red, and the LAIF rate, which is green. As I mentioned, all of the rates have been performing a little bit better over the last several months. However, they are still fairly low. This benchmark is a good indicator of the city's rate. If we saw the city's portfolio rate performing very differently from all of the 5-year, the 2-year, the LAIF, it would be a cause for concern. Either we're investing too aggressively or we are not investing in that 1 to 5-year range, which is what we normally would be doing according to our investment policy. You'll notice that the portfolio rate is just below the 5-year, but is higher than the 2-year and the LAIF rate, which is consistent with our investment policy. I did want to point out one other thing, that we are continuing to see that gap between the short-term and long-term rates narrowing. And so it just shows that there's less of a benefit of investing in longer-term treasuries than we saw in the past. I like to present this to you every quarter because it lets you know what the treasury yield curve is right before we come here to you. This represents what the yield curve was yesterday. And it's good news because it is up from what it was at 9:30. All of the rates are higher than they were at 6:30. From the 1 to 5-year, it ranges from 0.65 to 1.27. They're still low, but it's good news because they are higher. We're not sure if it's anticipation of this rate increase in December that many are predicting, or if it's just a temporary increase. In terms of quarter performance, the yield increased this quarter to 1.119% from 1.095% at 6:30. The interest earned for the quarter was about $389,000, and the general fund portion is $106,000. Total cash and investments amounted to a little over $140 million compared to $155 million at 6:30. So total cash and investments is down about $15 million. However, this is consistent with the timing of the year. Summer is when we do not receive some of our major revenues, such as property taxes. I did want to point out, however, it is a $12 million decrease from last year. However, we are waiting for an $11 million check, reimbursement check from the state for the desalination project, and we did receive that check yesterday. There's one other factor I wanted to point out that was in your council agenda report. The General Electric had a credit change during this quarter, so I wanted to present this to you. The credit quality change from Standard & Poor's was from AA+ to AA-, and this was due to concerns that the company was going to acquire additional debt to support an expansion. And anytime there's a change in credit quality, we bring that to Finance Committee. However, Standard & Poor's said the company's outlook continues to be stable, and per our investment policy, the city's investment policy, at the time of acquisition, any corporate notes need to have a minimum rating of A, so it's still 2 steps above that minimum rating. This chart is a summary of all of the investment activity for the quarter. You'll notice that $4 million of investments matured, 2 of them being treasury notes and $2 million being corporate notes, which were Toyota corporate notes. $14 million in securities were called, federal agency securities, and $14 million of investments were purchased. This represents $8 million of agency callable securities, $4 million of callable, corporate notes. $2 million were Toyota, which replaces the Toyota that we had matured, and $2 million were Wells Fargo. The last $2 million was money market funds. It's a temporary purchase, and it was moved into our checking account in early October. In total, $4 million was returned to our checking account. As I mentioned, $140 million, a little over $140 million, represents our total portfolio as of September 30th. This is a breakdown of the composition of our portfolio. Compared to 6/30, it was about $15 million less. The majority of that difference is represented in our checking account. About $10 million at 9/30 is in our checking account versus about $20 million at 6/30. I did want to point out that there is a new line on this statement that we haven't had before. I think the last time we had it was a couple years ago. The Union Bank Trust cash of about $9,000. That is a temporary account. It represents interest earned right at the end of September that is held in that account before it is swept into our checking account. This pie chart represents the same information that was on the prior slide, just in pie chart form. It is the composition of the portfolio. You'll notice there's some very slight changes in the composition because we did purchase some new corporates. In total, our corporates is 7% at 9/30. I believe at 6/30 it was around 4%. Our agencies represent 38%, treasuries 2%, CDs 5%. Airport note is still 3%. Our total liquid balance, which is made up of the checking account and LAIF, is about 44%. And you'll notice that new slice of the pie is that money market I mentioned, which is a temporary account, which has already been moved to our checking account. And that brings me to the recommended action. We are recommending that Council accept and approve that Finance Committee recommend to Council to accept and approve the first quarter investment report and fiscal agent report. And I can also answer any questions that committee does have.
Thank you, Ms. Nemus. Are there any questions for staff? Councilor White.
What's the process for purchasing new securities? Do you have advisors, brokers? Can you describe a little bit what goes on there?
Sure. Committee Member White, we do work with, I believe it is right now, 4 brokers that we go through, and we make them sign a certification every year. And we work with them. They work off of a list of, they have a copy of our investment policy. They know what we are allowed to and not allowed to purchase. And they provide us every day with new investments that are available to purchase. And we work with them. If we're interested in anything, we work with them on whether we like something that's on their list. And we will work with both. Bob will approve it as well, and we'll make the purchase. We sign the documents and make the trade.
And who are the brokers?
We have a list of them.
Are they in Santa Barbara?
No, I don't believe we have any that are in Santa Barbara. We have some that are in Northern California, some that are in Los Angeles. They're in different locations.
Could you provide that at some point in the future, please?
Absolutely. I could email you a list of all of our brokers.
One of the key aspects to that is, well, we get sort of these solicitations every day. The basis for us deciding what to invest in is a lot more structured than that. So the first thing we look at are what are our needs, and we've talked about in the past that we try to ensure that we have a really good maturity ladder, so that we're not seeing maturities lumped up together, as then we're having to invest potentially in a bad interest rate environment. So we want to have things sort of maturing every year in a staggered manner, and also provides enough liquidity. So typically what happens is we have a need identified by a gap in a maturity ladder. 2 years out, we have this gap where nothing's maturing, which means that we're going to have a need for cash. And so we'll look to fill those holes, those gaps, for example. And then secondarily, we'll look for, what are the yields? Are the yields looking good in those areas where we need? And we look for the best yield, not chasing yields, but just to see where the best opportunity is. And based on that criteria, so we see, okay, what are they offering? And then we see what that sort of meets our criteria.
Councilmember Dominguez, did you have a question?
Yes, thank you. For the corporate bonds, I'm looking at the purchase date and the final maturity. So are these like 2.5 year, or what's the outlook?
Committee Member Dominguez, I believe one was 2.5 year and maybe one was 3 year, but I have to go back and double check that.
So because the purchase date is listed as September 15th, and then the final maturity is in May of 2019. So I was just curious because that's not a 3 year or a 2 year, and it's not even 2.5. So corporate bonds are structured differently in terms of their maturity?
Corporate bonds can have all different maturities, and it really depends on whether or not they are, sold on the secondary market. It all depends on when the settle date is and when the maturity date is. But it could be 2 years, 4 months, 2 years, 6 months, 3 years exactly. They can all have different terms.
And you noted the market changes, and these don't impact us because we hold them until maturity?
That's correct.
Okay. And so the yield to maturity, the percentage, the 1.377 and the 1.307, those are just fixed in the contract or in the purchase agreement?
That's the fixed yield based on when we purchased it, correct.
Okay.
That's what we'll actually earn at the end when it settles, at the very end.
Okay, great. Thank you very much.
Thanks.
I don't think there's any other questions. So thank you very much for that presentation. Do we need a motion?
Motion to accept, is that what it is?
It's we're looking for a recommendation to council to accept and approve the report.
I so move.
Is there a second? Second. All those in favor say aye. Aye. Matter carries unanimously. Thank you. Next item on the agenda is the year-end financial results for the general fund, fiscal year 2016. Mr. Samario, are you going to make that presentation? Thank you.
Thank you, Mr. Chair, members of the committee. Bob Samario, Finance Director. So a little bit of background. You may recall that I think it was somewhere around 4 to 6 weeks ago, we were here presenting, Ms. Nemes and Ms. Tomaszewski were presenting the fourth quarter results. Those were preliminary numbers. They're close to final, but not quite final. And we had mentioned at that point that we would be back in about a month or so to give you the final numbers, the final numbers. Our auditors have been here and are gone. We don't expect any more movement in those numbers. It's just a matter of producing the financial report, the CAFR we call. So we wanted to bring you the final results and also as part of that show you how we ended the year in terms of our reserves. So this is really all about the general fund, and I'm going to spend a little bit of time on the revenues and some of the details, but not a lot, not like we've done in the past, but just really want to give you the bigger picture of how we ended the year for 16. So I'm going to be using this as kind of an anchor or pivot point for me to discuss each of the categories. And so what I wanted to do is first let you know that on a sort of a grand scheme, our operating revenues going across came in under budget by $5.3 million. So actual results were less than we had budgeted. And then similarly on the expenditure side, we were about almost $8.5 million below budget. And I want to spend some time talking about each of those kind of horizontally, and then we'll sort of focus on the middle column and more vertically in terms of what it really means on a bottom line basis. So this is kind of our largest revenues. Here it represents probably 70% of general fund revenues. I wanted to give you some context to the amended budget because it's how we have a huge variance, and it sort of suggests, well, what were we thinking that we had such a big variance there? So we started putting together this budget for 16 really back in October, November of 2014. So as we're in fiscal year 15, we start the preliminary analysis. Ms. Nemes does the preliminary revenue estimates, and somewhere around October, November, we tweaked the numbers all the way through March, but we're really looking at almost 6 months, maybe 7 months of data to develop the fiscal year 16 amended budget. And fiscal year 15 was really I think where things changed, at least locally from an economic perspective. We started to see in middle of 15 some changes to our key revenues, particularly sales taxes and TOT. We started to see the growth not being what we expected. And, when you see a month or a quarter of not the kind of growth you were expecting, you're not sure whether that's a trend or whether it's just, an anomaly. So we're always hopeful, and we don't want to, as you know, our approach is we don't want to overcut and overreact, so that, so we kind of are hopeful and just try to maintain sort of typical growth assumptions. But clearly, by the end of the year, it became obvious to us in 15 that our 16 budget was, really behind the curve. So the amended budget for 16 really, we kind of, once we got into it, we knew we were already behind the curve because we saw this not just an anomaly, but really a trend going forward particularly for sales tax and bed tax. And you can see that reflected to the right, that we ended the year $1.4 million below where the budget was. And then for TOT, we are $1.1 million below budget. We essentially ended the year on our bed tax flat. We had almost virtually no growth, and I think for sales taxes it was close to about 1%. We were assuming we're between 3 and 4% for sales taxes and 6% for bed tax. So a big swing from where we were a couple of years ago. Again, fiscal year 15, middle of that year is when we started seeing the change, but it's really now impacting for the full year, first time in fiscal year 16 and going forward. So you could see that just for these major categories, we were $4.4 million under budget. And you'll see that it includes $2 million of anticipated year-end variance. What's interesting is that when we were developing the 16 budget, we were seeing bigger numbers on the expenditure side. You remember, this is supposed to be representative of where we see expenditures to be under budget, not revenues. So it's an anticipated year-end variance on the expenditure side. We're typically at a $1 to $2.5 million variance. We were seeing larger numbers there over the last few years. So we, for the first time, bumped it up to $2 million. It used to be about $1.2 million. So $2 million is the bigger number, but we never expect to realize that revenue there. It's always going to be realized on the expenditure side on savings. So that variance of 4.4 is a little overstated just because we have that anticipated year variance that we don't ever expect to realize. I know it's a little confusing. We've talked about it every year, but it's just sort of it should almost be a contra expenditure account. We should almost sort of show it on the expenditure side as a contra savings, because that's really what we expect to see on the expenditure side, particularly from salaries and benefit savings, just vacancies and the like. So the 4.4 really is more like 2.4 when you look at the key revenues in terms of real performance during the year of our key revenues. Any questions on this slide? Does that make sense, sort of? So now on the expenditure side, so you can see again, very unusual year. I don't think I've ever seen our budget be this much, our actual results being this far below budget on the expenditure side. I mentioned to you that historically, at least on salaries and benefits, we're typically in the $1.5 million range. So being overall $8.5 million under budget is pretty extraordinary. I'm not sure I've ever seen that before in my 20-year career here. So I wanted to show you, just looking at within that, just the salary and benefits category. It represents about 70% of the overall expenditures, but you can see this is where we saw the biggest savings. To the bottom right, you can see that we are under budget on salaries and benefits in the general fund by about $4.6 million. If you kind of look up, you'll see that police had the biggest savings of $1.8 million. Through fiscal year 16, they were still having difficulties filling positions. We don't anticipate that to be nearly as big of a number going forward, but certainly in 15 and in 16, it was a big number. I think in 2015, they had about $1 million savings, and in this past year, 16, it was 1.8. But other departments were also facing vacancies. Parks and Recreation toward the bottom, $773,000 in savings. Same with Public Works down below that, $500,000. So almost across the board, because of vacancies, an extraordinary number of vacancies, we had a significant savings for salaries and benefits this past year. So to kind of round out where the rest of the savings come from, so the other category is really materials and supplies, special projects, but even there, that's a pretty big number, $2 million in savings in that category. And then the appropriated reserves, this is kind of inflated the number, but let me remind you that when we put together the budget for 16 and 17, at that point, we're expecting surpluses. You might recall that in 16, we were expecting a $1.9 million surplus and something close to that in 17. And so rather than show a surplus on the budget document, we appropriated that. We sort of set it aside and said, we want to make sure we don't spend this, and this will end up falling to reserves at the end of the year. Will help maintain our reserve balances and all that. So this appropriated reserve was the expected surplus at the end of the year. We didn't generate quite that much, but we came close to it. But that's why you see zero year-end results, because we were never expected to spend that, and so it helped force additional savings of $1.9 million. But still, it's a big number overall, $8.5 million. So $4.5 million, 4.6 from salaries and benefits, supplies and services, and other things of $2 million, and then this appropriated reserve, which we knew we were going to have at the end of the year as a surplus, brings the total to that 8.5. Any questions on this slide? Okay, so let's look at now, we're no longer, let's focus not on sort of budget to actual, because what's really important in terms of our reserve picture is how did we end the year more vertically? What's the difference between revenues and expenses? So you can see that the year-end results where we had revenues exceed expenditures by $2.4 million. That's really what's going to fall to the bottom line of our reserves. You will recall that a couple of years ago, we were still below policy in our reserves, and council gave staff direction that in 16 and in 17 that we should allocate, instead of 50% to capital and 50% to operating reserves, that we should allocate only 25% to capital, so that 75 more money goes toward our reserves to ensure that we hope to get us to the fully funded reserve picture. So based on those directions, we are going to be allocating $600,000 to capital, and that'll be programmed in 2018, which leaves $1.8 million falling to our operating reserves, and you'll see in a second how that plays out. Any questions on this part? So this 25% is a departure from the 50% policy, but this was per council direction to do that for 2 years to get us there. Okay, so this is our reserve picture. What I wanted to show is first what our policy was in 2015. So I wanted to show that because just so you can see how much our reserve policies grow just by virtue of our budget growing. The disaster reserve is 15% of our operating budget. The contingency reserve is 10%, in total making up 25%. So in 15, the policy reserve requirements were $30.6 million based on an adopted budget for 16. So the 15 policy is driven by the 16 adopted budget. The 16 policy reserve requirements are driven by the 17 adopted budget. And because of the growth in the operating budget, our reserve requirements went up by $1.2 million. So a pretty big number. So if you do the math, it tells you that the operating budget from 15 or from 16 to 17 grew more than $4 million. It probably grew somewhere around $4.6 million. So a big number. So again, we talked about how it puts pressure on us to maintain those reserves because every year we have to generate some amount of surplus just to stay even, right? In this case, we had to generate $1.2 million just to stay even. Our actual balances we ended up the year at policy reserve slightly above this at 139. So we still are, for the second year in a row, fully funded on our reserves. I will tell you that the 139 is a little bit inflated in that we are going to be transferring as part of our first quarter in 17, $146,000 to our fleet fund to deal with some shortfalls we have for our fire vehicles. We talked about internally that because they're generating so much more money or profit on the mutual aid calls, they're actually making a profit, that we would use some of those monies to help deal with the shortfall in the reserves for vehicles that are just becoming in more expensive. So this number is going to be slightly lower. So we'll still be right around policy, but it'll be more like $6,000 below policy once we make that transfer technically. But essentially, we are fully funded again for one more year, which is really good news. And we're looking now at almost $32 million of reserves, cash on hand to deal with either disasters or any other kind of contingency. Any questions on this? Okay. So this is just a pictorial illustration that shows over time kind of how we migrated from where we were a number of years ago below policy, where the last couple of years, 15 and 16, 15 being the first, we are now fully funded our reserves. So we've come a long way, and it looks so far, at least through the end of last year, we are still in fully funded reserve status. Okay, so what I want to do is sort of focus on no longer on last year's results, but to talk about what did last year's results do to this year? How did the results of last year impact where we're at today? And what are sort of the long-term impacts of that, really particularly going into 18 and 19, the next 2-year financial plan? What are we kind of be looking at based on what happened this past year? So I mentioned that, we developed the adopted budget obviously a long time ago, but when we developed 17's budget, again, we were looking at more recent data, so we weren't relying on the 2016 adopted budget to determine what we're going to budget for 17. We obviously have a lot more data. Effectively, our budget for 17 was based on what that first column numbers is the March revised. Those are our projections for 2000 at the end of 2016. The latest projections, what we thought we would end the year, and that was the basis for us building 2017. Clearly, for example, sales tax was well below our budget for 16, so we were projecting a lower number, so we had a lower base to move into 17. But just because of what happened between March and the end of last year, those 3 or 4 months, we are already sort of starting below the curve in 17. And in fact, if you the bottom right, you'll see that based on the results of the last several months of the year, last year, relative to our projections, we're almost $450,000 sort of out of balance already, just on the revenue side, not factoring anything else. Just July 1, because of what happened relative to our projections, we're about almost $500,000 below the curve or out of balance. Does that make sense? And what's interesting is even on property taxes, we were $139,000 below what we projected, because even though we had overall growth in property taxes relative to others, we weren't expecting a decline in certain categories of property taxes that dropped that number below our projections. Okay, so let's play that out. So our adopted budget for 2017 at the bottom left is $86.7 million, almost $8 million. Because of the growth rates included in 17, that 447 in 2016 translates into really a $463,000 shortfall this year. So, because of the lack of growth that we're expecting, it's really a little slightly bigger number of 463. So again, July 1 really is what we're looking at being out of balance by 463. But there are other things we wanted to consider. So we looked at a few things. One is, should we be looking at the assumptions built into the current year adopted budget? For example, sales taxes, because of the timing, we were being a little optimistic and we weren't really seeing all the data, but we assumed a 3% growth in 2017 for sales taxes. We've not seen even a 2% growth in the last almost year and a half, or maybe 2 years. So for now, this is not something we've done, but if we were to change that assumption from 3% to 2%, just drop it to 1%, that would have an impact of $215,000.
Right.
So repeat that last
Yeah,
part. The
so
3%, what's
Yeah,
the
so
3%?
the
2%?
17 budget assumed a growth of 3%.
Okay.
On our sales taxes. We're thinking now that might be likely to be too aggressive. So as we start thinking about, the rest of this year and next year, what do we really think is going to be the growth in sales taxes? That's the one that kind of sticks out for us more so than others, that we think that 2% is probably the better way to go, and even that might be a little aggressive, at least when you look at the last year and a half. Like I said, we have not achieved a 2% growth in maybe one quarter over the last couple of years. It's been more than 1% or flat or down. So that I just wanted to show you what would be the impact if we just dropped that one growth assumption for this year. TOT is a couple things going on. First, the vacation rental. When we developed the budget for 17, we made some assumptions about what the impact of our enforcement on shutting down vacation rentals would have on our revenues, and based on what we know now, we believe that we're going to see a quicker decline in our revenues than we initially anticipated. What's going to happen at the end of this calendar year? We're no longer going to be issuing business licenses, and we're going to basically, we're going to presume that everybody is out of business in terms of those who are registered with us. So it's pretty likely that we're going to see by the end of this year, in 17, all of our revenues basically go down to zero. We'd expected that it would be kind of phased in over a few years, but we think it's going to all happen between last year and this year. And so that's going to have an impact this year, for at least for half the rest of the 6 months, of about $268,000. So that's that number there you see on the TOT. The change in what we now believe to be the case of the decline in TOT from vacation rentals this year will be about $268,000 hit. To the right of that is, we also have results for 2 months of TOT, and they were not great. September ended up doing pretty well. I think it was like 9%, so it was like, I don't know where that came from, but the first 2 months were not good. And if you just factored that in real terms, because those are real money that we didn't get, and they're big months, July and August, that alone, not even thinking forward, will have an impact of about $219,000, $218,000. And then the other stuff is just based on July and August results. If we had to tweak it, now we have to tweak the numbers just for those 2 months. You see the impacts. So the sum of all these adjustments and assumptions, changes, we're looking at this year being almost $2 million kind of out of balance. So as we're starting to develop next year, we're already thinking about this and what that means to us. Questions on this slide? So if we take this and sort of as we're thinking about in the next 2-year financial plan, and particularly the first year of that, 2018, some other things start to materialize. So in 18, we lose the rest of the TOT because remember on the vacation rentals, we had assumed we're going to get 6 months this year, and we made some adjustments for that. But by starting next year, we're not going to see any of that. And that's going to result in an additional $700,000 ongoing impact beyond the 1.2 that I mentioned. And then you might recall that when we balanced the budget for 17, we ended up having, we used about $300,000 to close the remaining gap, a little bit of a gap, and we achieved that through a hiring slowdown. So we weren't going to fill positions as quickly. But that's a one-time measure, so that we have to kind of add that to the equation of our ongoing sort of out-of-balance number. So it's really more like $2.2 million that we're already kind of out of balance for 18. 1.2 this year. But when you go into next year and factor the other things, we're now at about $2.2 million. Some possible offsets, you're familiar with the Jack's case, the Roland Jack's case. That's the 1% on electric franchise fees. We're collecting the money, but we're not treating that as revenue because it's potentially we have to pay it back. But if that case were to turn in our favor, so maybe this spring, that's at the state Supreme Court, we would be able to treat the money that we have collected so far as sort of revenue, but then on an ongoing basis, we'd see an additional $700,000 per year of revenue. So that would, obviously help. And then Lalonde Trot opening could be May, could be, sometime early summer. We're thinking it would open up. That's not factored into any of these numbers. And that will definitely have an impact. A full year of that facility being opened up, and the TOT we would get from that is pretty substantial. I don't want to give you numbers because that's a little bit confidential, but it's a big number. It's not quite $1 million, but it's getting close to that. So those are some good things that are going to potentially offset. But we wanted to give you really a sense of what we're kind of thinking about already as we start developing the next 2-year financial plan, and that we're going to have to deal with this $2.2 million impact minus whatever Lalonde Trot helps us with. And that's really my presentation.
Thank you for that information. Questions? Councilmember Dominguez?
Thank you. The $700,000 figure for the Jack's case, does that include both the general fund half cent and the undergrounding half cent?
So right now, all of our franchise fees for the electric goes into the general fund. Once upon a time, a number of years ago, we used to allocate, just by city policy, we used to allocate half of that to our undergrounding utility fund. But we had very little success in getting residents to participate in that because there was always the private benefit component, and people have to agree to self-assess, and we couldn't get folks to do that. So the program really didn't go anywhere. And then coincidentally with that, we had the recession in 2008 and 9. And so at that time, the city administrator decided just to move that money into the general fund to help balance our general fund deficit.
Thank
so
you.
That represents the full 1%, the $700,000.
Thank you.
Councilmember White?
Thank you. So is the Santa Barbara Inn meeting expectations on its revenues? So that's the other new variable out there.
As of August, they were still below expectations, but I don't recall how they performed for September. I could get back to you on that, though.
Well, thank you.
And considering the hiring slowdown as a one-time measure, I think in light of this circumstances, that's probably not going to end up being a one-time measure, because that was obviously a very effective tool at limiting expenditures over the last fiscal year.
Right, that's true, Mr. Chair. Although I think whatever we do next year, to the extent we have a sizable problem to deal with, we may be looking at actually eliminating positions. So it's not really slowing down, but looking at through attrition, vacant positions, and seeing where we can pare down the numbers to save real dollars on a permanent basis.
When you look really carefully at those salary savings by department, obviously the police department is the big anomaly because there were so many vacancies. But the churn that these numbers represent for the other departments, that felt as though it was a unique one-time, lots of people retiring at a given moment in time, and then a larger savings by not hiring right away, and that isn't replicable on an ongoing basis.
Yeah, I would say that it's not replicable. Again, just talking to, for example, the police chief, we're already we've got a lot of people in the academy now. We're not expecting this nearly the same amount of vacancies. And same with Parks and Recreation and other departments where we had vacancies. They're trying to fill those positions. So my guess is we're going to still see some savings in 17 because I don't know that we're going to be able to get all the way there. And that to me is sort of a one-time pot of money that falls to reserves that help us maintain fully funded reserves. But we've got to balance the budget on an ongoing basis and assume those positions are eventually going to be filled. So to me, I see that as sort of one-time money.
So the $2 million variance that you normally build in for that salary churn, the $300,000 that you sort of estimated would be in excess of that $2 million?
Yes.
So then when you actually achieved 4.5, a lot of that is the police department.
Yep, that's right. The one thing I will say that I think is going to help, and we're almost through finalizing our projections for salaries and benefits for 18. So we're already working on 18. What happens when you do see a lot of turnover in a particular year, and we talked about this before, so when you redo those projections, sometimes you see those numbers really fall because now you're filling positions with positions at a lower level, or when there's a lot of vacancies, you're forecasting those positions at step one. And so in reality, you may be hiring people at step two, but from a budgetary perspective, just the way we do it. So, this 2.2 doesn't consider how the expenditure side of the equation looks like, and we're working on that now. And that's why I said it's strictly a revenue issue right now, but we might find some of that sort of offset even with some lower projections than relative to the previous years.
Okay, that would be definitely good news.
Yeah, so I'm hoping for that.
Yep. Any other questions? Well, it certainly highlights the wisdom of having the slowdown. I mean, that definitely is why we're going to at least start the year in reasonably decent shape, and regardless of how the trends are going in terms of revenue. So thank you for that and recommending that.
Yeah, and so what we're going to do, I'm going to make the same presentation to the City Council, so I apologize for that, but the same slides, we'll go through it so they can all hear it as well.
Okay. Well, and then there's no motion necessary because we're going to have that at council.
Right.
All right. Well, if there aren't any other questions, then we are adjourned.
Okay, thank you.